Hey everyone, my name is Kevin Foreman. I'm the founder and president of Black Sheep Business Consulting. And today we're going to be diving into the first of a three-part webinar series on financial projections. Today, we're going to be focusing on developing pro forma income statements. And this is super important for businesses because as we approach a new year here, lots of things are changing. It's really important for business owners to be able to stop, go through their finances, even if it's not their strength, and break down their different revenue streams, their costs. And it's incredible when you start to plan and you look ahead what that can do for you as you get into the year, right? You want things to be second nature as you go into the year. So by building out your financial projections, you can already get ahead of the curve, identify costs that are coming up, identify new revenue streams that you might be building out, and everything becomes second nature and it really can help your business. So that's a bit of an intro. Let's dive into it. And here we go. So some things we're going to be covering today is breaking out revenue streams and pricing, understanding cost of goods sold, common operating expenses, the importance of a healthy EBITDA, and understanding growing your company's net income. So in this first slide here, we have pretty standard start to the income statement. So the income statement itself is the first of three different types of financials: income statement, cash flow, and balance sheet. So the income statement is often the first start. The income statement is often the first part of these three different types of financials. One of the first things that we look at is the months or the dates that you're going to be building out your projections on. So in this first year, there's of course 12 months. You can either list it out monthly, month one, month two, month three, or you can include actual months and dates. So for example, January 2024 all the way to December 2024. The advantage of actually listing out the actual months and dates is that for businesses that experience some seasonality, and most businesses do, you're able to kind of include that into your projections. So it's really personal preference, but typically companies will include, their actual month and date of the year. Here we have the first of our revenue streams. So as you can see over here, retaining wall installation. So this is a hypothetical property service business. So the first service is retaining wall installation at 12,500. If your company provides, so just a part of building out projections is there are some assumptions that need to be included, right? So for example, an assumption might be, well, the average price for a retaining wall that we charge out is $12,500. Some are 10, some are 15, but the average is about 12,500. That might be an assumption. Another assumption that you could include is, well, we build out retaining walls for, small homes, for large homes, and for commercial. And those three might have their own average price for each, right? So part of building out projections is that you have to kind of be okay with some imperfection. You want to make it as accurate as possible, but for certain businesses that their prices vary depending on the project. It's better to build out projections and make assumptions than to just say, well, there's no way to, ensure that it's 100% perfect. So what's the point? You'll find that by actually investing into it and, including some assumptions, you're way better off in the end. Here we have our second revenue stream. So cedar fence installation at $9,000. And finally, strata monthly landscaping at 7,800. So when you look at these three different revenue streams, one thing you should be able to notice is that the top two are products. They're installing a retaining wall and cedar fence installation. And the third, strata monthly landscaping, is really primarily a service. Now, as we look into the year, and the time of us developing this is January 2024. We like to highlight where the units are, where the strongest monks are going to be. So for example, for retaining wall installation, this company is saying, well, we think June, July, and August, those are going to be our best months for business. So we've highlighted that in a bit of a darker green. For strata monthly landscaping, it's throughout the year. The contracts are monthly and, it goes throughout the year. And what we've done here is we've included a few different units. So for example, for this company, we've taken retaining wall installation. We've said for months January, February, March, there's 0 units sold. And our first one is in April 2024. So we have a 1 there. And the calculation in the sheet is this square right here equals the price per unit times the number of units. So 12,500. As we go into June, these are the strongest months. So we have 2, and you can see it's 25,000 because it's 12,500 times 2. With regards to strata for monthly landscaping, let's assume this company already has 1 contract in place going into the year. Then in June, the assumption is, well, it gets busier, so we project to win at least 1 other contract starting in June. And Horace, one of the things that's been communicated is essentially in projections, it's never perfect. So it's much better just to make assumptions and to do your best to make accurate assumptions than to not make projections at all. So now that we have built out our revenue and it's complete at $379,200 for the first year for this property service company, we're now looking at cost of goods sold. So this company, Horace, has 2 products they're selling. It's like a property service company. So it has retaining walls that it installs and cedar fences. So we're considering those 2 products. Then it has 1 service, strata monthly landscaping. If this business was purely service-based, then when it comes to cost of goods sold, there'd be no materials and it would just be employee wages. Because this business has both services and products, we're going to include materials and also employee wages. What the calculation is here is we've taken an average for materials of 40% of all revenue that comes from these 2 product revenue streams. So the calculation is cost of goods sold equals the sum of revenue from retaining walls and cedar fence per month times 40%. As you can see, we've taken that right across. In the first month, 12,500 is the total between these 2, and 40% is 5,000. As we go up to July 2024, 50,000 in that month, plus 27,000 for cedar fence. So that's 77,000 times 40%, 30,800 is the projection for the materials.
At when it's the cost of goods sold, at what point would we include things like, just using this company as an example,
Yeah.
of the gas that it would take us to get from point A to point B, the cost of anything else that we'd have to do to the materials to have it ready?
For sure, for sure. So there is something called GAAP, generally accepted accounting principles. Okay. And it's like internationally recognized. So when it comes to cost of goods sold, there's actual accounting benefits to including things in your cost of goods sold. So there's like a very fine line in what you can include in your cost of goods sold. It's primarily like from a really high level, it has to do with what goes into providing your very core service, right? So, for example, with regards to gas, I don't want to give you the wrong answer on it. So, if it's gas for a truck that's actually building the retaining wall, that's going to be showing up and is going to be working on it, that very possibly could be included in cost of goods sold. But if it's the gas for the CEO's vehicle and he's driving to meet somebody for a business matter, that most likely would not be eligible as a cost of goods sold item. I would just say referring to your actual CPA for that one would be best.
Okay.
with regards to employee wages, we've done a similar thing. So we've taken 30% of all revenue going to employee wages. So if you have a new business and you're unsure what you're going to have to spend for employee wages, a way to get things going in your projections is to just say 30% of all revenue will be going to employee wages. The reason why I recommend just going with something to start, like 30%, for example, of all revenue, is that way you can complete your income statement. And at the end of this process, what we're going to show you is an employee recruitment plan. And what we do is we cross-reference it. So you might take 30% of all revenue and build it out. But at the end of the process, before your income statement is done, you have an employee recruitment plan. You say, well, regardless of what it says in the income statement, we know we need 3 staff members, all of them full-time, each month of the year, using the job bank. Here's the average amounts that they're all going to be paid. So it's just a way to kind of get it moving, is to take in a percentage. A lot of businesses that have a long history of financials, we can take their financials and say, employee wages or salaries to revenue historically is right at, 28% of wages to revenue. And then we can take those numbers and it can be a lot more accurate. But just to get things started, you can use a simple calculation like 30% of revenue. But again, you'll likely need to update it once you've completed your employee recruitment plan. And we're just showing a similar thing. You're taking 5% of revenue. Another thing you could do is you could take a percentage of all the employee wages, actually. So you might say, 20% of all employee wages that are paid out are going to benefits, which might, constitute provincial or state benefits, federal, and any additional items. This is a very simple calculation here. So now that we have revenue completed, so we've built out revenue, as you can see over here, here's the total for the year. So $379,200. Then for cost of goods sold, which are your main expenses, we have $225,120. So when we find your gross profit, we're going to take revenue minus cost of goods sold equals gross profit. So you have $154,080 left over. Now we have your operating expenses. So everything outside of your core costs to operate as a company, right? So everything outside of those main employees that are actually, building the product, delivering the service, any of your core materials, that comes into operating expenses. So as you can see on the left here, we have accounting, bookkeeping, bank charges, insurance, legal fees, marketing, advertising, phone, internet, cable, point of sale, system fees, rent, utilities, contingency. Horace, do you have any questions on those different operating expenses or any that come to mind?
No, they actually all make sense.
Yeah, and here's like for a small business in its first year of operation, we have some pretty standard pricing in here as well. It can definitely be a lot more. There could be other operating expenses, but so as we move to the next slide, the next calculation is gross profit minus your operating expenses equals EBITDA. And EBITDA in itself is something you're going to hear a lot from investors. It's essentially earnings before interest, tax, depreciation, and amortization, EBITDA. So the reason why investors and people in the financial world care about EBITDA so much is if you have a strong EBITDA, but if your net income is low, you can deal with that. Here's why. Earnings before interest, tax, depreciation, amortization. You can pay off any debt you have and work a few things out to ensure that your net income is improved. So if an investor's coming in, they say, wow, they've got great EBITDA. It's, it's 30% of revenue. It's really strong. Well, if you have tons of debt, that can be paid off. And all of a sudden your net income is boosted instantly.
So we don't calculate like loans or investments within the sheet.
So that's something we're going to look at next year. So basically, let's go into the next slide. So we have EBITDA Now we have EBT. So interest from a loan. So just to show you here, we've taken like a fresh loan here and started it. So your interest technically comes after EBITDA. So it's an expense, of course. And depreciation also needs to come out of it as well. The actual principal payments on the loan, that will come out of cash flow. So note it's strange, but that's just in financials how it works. So if you have a loan, and let's say it is $100,000, 5 years, and it's at 9%, we can take an amortization calculator, put all the interest payments coming out of the income statement. The actual principal payments will start low and it'll go up every month, whereas interest starts the highest at the beginning and it goes down. And the principal will come out of the next document that we'll create in the next webinar, which is cash flow. So in financials, you're really not supposed to put, hey, well, the bank said, our payment is $1,160 a month. So we're just going to put that in EBITDA. Technically, you should be putting the interest from those payments starting the first month where it'll be the highest and it'll go down every single month. You should be putting that into the income statement, and in the cash flow, the actual principal should be coming out of the cash. And if you stick around for our next webinar, we'll be able to make a little bit more sense of it. Does that kind of make sense, Horace? You can explain, you can say if it doesn't.
It kind of does make sense,
Yeah.
but on a monthly basis,
Yeah.
like if I look at someone's financial sheet, I wouldn't see that at that point.
Right. So to properly present financials to banks and investors, you should follow this path. Okay. If you're doing your own projections for yourself for the year, a route that you can take, because let's look at depreciation, for example. Are you actually, so let's say this company has $50,000 of hard assets. So they bought a piece of equipment. Okay. And they're starting a new business. So you take GAAP, generally accepted accounting principles, and you say equipment, how long should we depreciate it for? It's probably anywhere from 5 to 7 years. You would take that and depreciate it over the 5 years, and it would come out of your income statement. Would you actually be spending money on that each month? Of course not. It doesn't actually come out of your account. So all I'm trying to get to here with regards to, the interest payment, depreciation, you could, in your own financials for your own forecasting, put in exactly what the expenses would be. So you could put in for net income, you could put your exact payment each month for your loan, which might be a total of $1,160, and leave out the depreciation. So that is a route that you could take. But to really properly forecast everything, it's best to follow the actual financial rules.
Okay.
One thing we've added here now, so we've got EBTs. We have EBTs. We've taken EBITDA minus the interest on a monthly basis minus the depreciation, and we have our EBT, so earnings before taxes. Then we have the actual taxes. So depending on where you are in the world, the corporate tax rate is going to vary. Definitely across Canada and the US, it varies. For example, in Canada, up to a certain amount, it can be a certain percentage on corporate tax, and then it can increase. In the States, similar, depends on the size of the business and the amount of revenue and what you've paid. So that can really vary drastically. Also, the state that you're in, it can vary. So it's always important to understand your local taxation rules. For this business, we've taken EBITDA minus interest minus depreciation. We've got our EBT here of 94,000, deducted the corporate taxes for the year, and there's a take home for shareholders of $82,735 for this company.
Sorry, I just wanted to ask, as a small business, we'd be applying for different grants and shred claims and such. Where would that fit into here?
For sure. So with regards to shred, that would typically come in down here. So it's usually it can be an offset of the taxes that you're paying as a company. So on dividends and whatnot. So that would be down here in this area right here. With regards to say say you win a $50,000 grant, um,
Yeah.
that's often coming in other revenues. So up at the start, we had our three different revenue streams. You'd often have another line item, which would say other revenues, and you would show that revenue coming in and going through the full cycle, the life cycle of expenses.
Okay. And then as well as money still to come in from vendors that hasn't been paid.
For sure. So the income statement or profit loss statement, which is, today's, and it's the first of the three-part series and the three parts of financials, it's really linear in that it's showing either your past. So right now we're doing pro forma, so we're looking into the future, but
Okay.
it's either past or future or the present month of revenue, what you've spent, and what's left over, whether it's in the past or looking into the future. Cash flow is going to go into the cash you have, the cash you spend, cash you bring in, and what's left over throughout that inflow and outflow of cash. The balance sheet is the last one to complete because they all actually work together. And in the balance sheet, that's where we're going to show your assets, liabilities, and shareholders' equity. To answer your question, that's where you show your accounts receivables and accounts payable. So at the end of the year, so let's say right now we're in January 2024, a few weeks ago, you might be saying, well, we brought in $1 million of revenue this year, but one of our clients, we're just about to finish up their project and then they're going to pay a large sum. It's going to be $200,000. If you get to December 30th and the invoice is published, if your year end is December 31st, you would still claim that as revenue for that year. And in your balance sheet at December 31, you would be showing accounts receivables, which is an asset of that $200,000 invoice, plus anything else that might be outstanding. So in the income statement, we wouldn't see accounts payables or accounts receivables. It's only going to show what's actually, going through the register each month, essentially.
Okay.
With that being said, it's all invoices published.
So when we are doing this income statement for the future, is
Mhm.
that something that we keep in mind, or we just don't think about anything like that?
When you're building it up for the future, try to include your actual invoices for the month, basically. So if in January 2024, for example, you're doing $7,800 of business that you're billing out, include that. When it comes to building forward-looking financials and you have accounts receivables, because every year it's a normal assumption to say, okay, we did $500,000 of revenue. Based on our type of business, we assume at our year end point, we're going to have, let's say, $20,000 that's outstanding. For some companies that have like long payment terms where it's 30 to 90 days, you might have 20% of your revenue that's still outstanding, right? Because it's the nature of the business. So it's important to ask yourself in your industry. So if you had a smoothie shop and it's all in-person smoothie purchases, every single day, like at year end, you're basically going to have no accounts receivables because everyone's paying for that smoothie while they're in your location, right? So it depends on the type of industry that you're in with regards to account receivables and also account payables a lot of the time.
Okay.
Do you have
Okay,
a
that makes sense.
yeah, do you have a specific example of one?
For instance, when you deal with a lot of the Fortune 500 companies, it's usually that 30 to 90-day pay period after you've invoiced them, right? So I would figure, yes, I have an income. My income statement is saying I'm going to make 7,800 for
Mhm,
these certain months, but
mhm.
at the end of that month, I might not get paid till 2 months down the line, which would kind of
E-
inflate the numbers at certain month part
Right.
points.
For sure, for sure, for sure. So in your cash flow statement, which is the next of the three, so next week, your net income, it'll show the inflow of net income each month. Um, so yeah, there has to be a bit of a buffer there for the assumption that things may not get paid, or it may come through, 1 to 3 months down the line. One thing that can be done is you can ensure, and this is always healthy for all businesses, that your cash is substantial, right? So this is the number one thing that small businesses run into is they run out of cash. And you bring up an excellent point with regards to Fortune 500 businesses. Walmart, for example, I've heard are notorious for getting into engagements with different vendors where they actually have 6 months at times to pay the vendors. So can you imagine being a small business that's growing? You get into Walmart and you sign an agreement, you send out your products 1 month, and it actually takes 6 months to get paid for that first month's sales. And that continues each and every month. So it's something that needs to be considered when you're building out your projections. That would be primarily on the cash flow side. So it's important when you look at financials, and the more that you build them out, the more you'll see the income statement, which is what we're doing right now, very linear. It's okay, we're selling this much, we're selling this much each month, or here's our costs. And then when you go into cash, it's different because it's an actual checksum, like it's an actual balance, and you can see over time exactly what's happening regarding, cash is going out, cash isn't coming in. So if you were in that situation where you had a product and it's going to take 6 months to get paid, we would have to ensure that you have a really strong cash position for the first 6 months of that company, or pretty much at all times of operating that type of a business.
Sorry. So if I'm starting a business and I definitely know I'm going to I signed a contract with Walmart and I'm preparing these documents now. Is that something I think about at that point when creating my revenues, my gross revenues and what for each month?
Yes. So what I'd say to that is try to, if you're going through it, try to first think linear about net income. So build this out and think, hey, what are our sales actually going to be? What do we have to spend? And just build it out honestly. Then when you get to cash, it's important to look at when money's actually coming in. So, I mean, most businesses are going to be paid within about 30 days of, an activity taking place, typically, but not all, right? So if you are in that extreme position where it's 6 months down the line, we would need to for sure at that time look at how long it's going to take for payments to actually come through. And we would have to build in the cash on hand getting started, whether it's zero to start and then a large loan or a large inflow of, investment capital from yourself, from an investor. It would be in the cash flow that you would really look and deal with that issue of, of how long it's going to take to get paid. Then when you go into the balance sheet, a part of your assets is going to be accounts receivable. So you would look, okay, at the end of the year, it takes us 6 months to get paid. So there might be like 5 or 6 months of accounts receivable that's going to be built into what you're owed at the end of the year. And just again, your revenue that you would declare would be for all those sales throughout those 12 months. Even though you haven't been paid at the end of the year for maybe 5 or 6 of them, you would still say our revenue is everything we invoiced in these 12 months. Just in your balance sheet, you'd be saying our accounts receivable are quite high because it's 5 or 6 months of the entire year.
Okay.
Here's year two. So in the first year, we had about 379,000 in revenue. It's grown over time, just the assumption that more business is taking place. We've kept in these exact same percentages for cost of goods sold. And one of the beauties of building up projections is that if you build out your first 3 years of projections and you keep it, you saved it, great, and you go out, you work really hard for a year, and then you go, wow, we should really report everything with our accountant, we're finalizing it all. You might want to forecast the next year. It's great to look back and go, we did better than expected. Why? Maybe you pivoted and you offered a new service, or you sold more than you expected. And there's always going to be a reason why you did or did not perform how you expected you would, which is totally okay. But when you start to plan, you start to understand your business a little bit more intimately. And that's really important year after year. So it's a huge value in that. Net income has gone up over time for the new business owners out there. There's often a lot of, it costs X amount with operating expenses to have this business function. And that's often for a lot of companies a loss in the first year. What you'll find is as you stick it out over time, a lot of those operating expenses either stay relatively the same while your revenue goes up. And for this business, this hypothetical business, the same thing has taken place. They had, I believe, less than 100,000 in net income in the first year, and it's starting to really quantify.
So were you suggesting, as I go through my first year, I did better than I projected, to go back and review my statements and make a change to them
I wouldn't
with
make,
the new numbers I have, or understand why
yeah,
I made more and in what spots I've made more?
that's the main takeaway right there. I would keep your so what we do is we'll have copies of various financials for clients, especially if we work with them over time. So we'll say like, here is our projections in 2020 for 2020 to 2025, and we keep those. The next year we might build new projections and we might delete different services and add certain things, and there might be different seasonality, but in building it out, we're always going to assess with them and say, hey, what did we forecast for this year? And why was it different? And the main thing is as a business, you want to go through it and understand what changed and why, because that information is some of the most critical information that you can possibly have as a company. Because what if something happened where a competitor came in and they started offering something that might spark an idea of something that you have in your back pocket, like an idea, something that you can introduce, or maybe you across the board had all of your expenses way too low. So you made the exact same amount of revenue, but your expenses, whether it was cost of goods sold, operating expenses, it was like 30% less than it should have been. And like every single line item it was. Well, that's something to look at, right? Why were our expenses, so low? Maybe we just didn't include enough, or maybe there was another factor at place, right? So it's just important to always dive in and get the best possible understanding of why your projections were on point and why they weren't. And it's as much about your projecting as it is about external factors, right? Maybe inflation came in and boosted the prices of everything. What if you have a restaurant, right? And inflation comes in your first year, hyperinflation, and your costs go up, your audience doesn't go out as much for dinner, and it's really ugly, right? Maybe that's a factor a little bit outside of your own control, but still you want to understand what happened, and then what you can do is something interesting. Just in that situation, for example, is you could say, well, what are the most successful businesses doing that are in hospitality and restaurants, right? And to answer that, I think a lot of them are charging more, and a lot of them are just breaking even, to be honest, and like keeping revenue going and just breaking even. But yeah, so it's really, there's a lot of value in looking at your past financials. So this is a 3-year projection. What we've done is we've taken the totals for all 3 years, we've put them here. This is something that a bank or investor would love to see as far as what you're forecasting. The total is the sum of each of these 3 years for each line item. And this percentage is percentage of revenue. So this is the total revenue divided by this, it's 100%. So it's 100%. Cost of goods sold over the 5 years is 50.39%. Net income over the 3 years is 30.6%. You can build out 3-year projections. You can build out 5 years. I'd probably stick in the 3 to 5 year range. Anything over 5 years is you're really going into the future quite far, and it's probably going to be not as accurate as it could be.
Which one of those percentages would I like to see down or up?
For sure, for sure, for sure. So cost of goods sold, for sure. So revenue, of course, is a good one. We want to have as much revenue as possible. And like a lot of people in the financial world will say, oh, everybody wants to get lots of revenue and it's not really even that important. It's really your bottom line. So it's your net income. But here's the reality is as a business, you have to first think very long term in anything you're doing. Building revenue as a new business is a great thing, right? It's showing that the wheels are turning and financially the business is operating. I think the best approach is first, boost your revenue. So, and from an operational standpoint, do a great job, provide an amazing product or service. So, first, boost revenue as much as you can, then lower costs, and then you have your profit. So, year one might just be like, okay, let's get this thing going. Let's make sure it's operating. And year two, you might be saying, okay, let's really now build on everything we learned and really boost revenues a bunch. And you might be breaking even by year two. Just honestly, it's pretty realistic. Year three, you might say, okay, now we're really warmed up. Let's really grow revenue. And at the same time, let's take the data from years one and two on where we spent too much, and let's make changes from an operational standpoint, from an HR standpoint. Let's make some tweaks. Let's bring down our costs. And then year three, all of a sudden, you're making a healthy return. And then year four, you should, with the data that you get from your financials, you should be able to just tweak things, learn from it, and continuously, just continuously grow. So it's like you're at, a dashboard when it comes to financials, and you're just turning things up, turning things down, testing things. And yeah, businesses that plan and have the data, they're the ones that do the best over time. It's the ones that don't plan that fail. So to really answer your question there, revenue you want to go up, cost of goods sold, it's something you want to bring down. At the same time, in the vast majority of businesses, your staff are going to be one of your main drivers of growth, main drivers of productivity, main drivers of customer satisfaction. So it's a give and a take. Would you like it to go down in cost? Of course. But at the same time, it's like marketing. It's a important expense. Okay. When it comes to, supplies for the business, if you can bring those costs down, of course. But yeah, it's something you want to bring down, but you just want to be conscious of it. Gross profit, you want it to be as high as possible. Operating expenses, for sure, you want a lot of them to go down. Again, marketing is one where I go, don't be afraid of it. Like step into it, get the data, be a little bit frugal, but overall, don't be afraid to spend money on marketing. And yeah, I mean, interest is definitely one of the biggest ones that you want to be bringing down. If you can grow lots and you can be super profitable, then you can pay off debt. At the same time, if the amount that you're paying in debt is drastically less than your growth, then that's okay. So use debt if it's going to help you to grow. But if it's getting so high that it's really impeding your growth, then it's certainly something you want to look at paying off. Here's the employee recruitment plan. So what we did is in the sheet, we've said this equals in year one, the total amount of employee wages. Here's year two, here's year three. This is the final version of this. What usually happens is you put this in here and you're either way off with regards to what you actually need, or you're relatively close. But the key here is to ensure that both of these match up. So if this side of it wins, and if you say we need a foreman, a skilled laborer, and another laborer, and the director would be the business owner themselves. But if this came to $200,000 and you said, no matter what, for the work that we're going to do, you have to have that budget, then you would go back into year one and you would adjust this number to ensure that over the course of the 12 months, you have $200,000 in employee wages. And it's not doing anyone any favors if the numbers aren't honest and truthful, because then you're just going to go into the year and, things are going to be as pretty as you would like them to be. So you're way better off to just be as realistic as possible when you're building this out, and that will really help you. And the whole key with all this is then it becomes when you step into the actual business, it's all second nature, right? I can't explain how many times we've built out projections with clients and they've gone, wow, I'm actually going to, reconsider purchasing this company, which isn't something we want to do. We want people to grow and be excited, but I'd way rather have somebody look at their company and go, geez, we have a lot of huge expenses coming up. We really need to be frugal in these areas, because then when you step into actually operating and making decisions, everything comes second nature. You know that you're up against a great challenge. So that's the whole beauty of building up projections, is all the reality can kind of come to light, and then you can make better decisions when you're actually in the field. And that is it for the webinar. Thank you so much, everyone. And we have the next presentation next week. Looking forward to it.